Welcome to Talk Tickers. We break down the key earnings calls and business updates so you get the crucial insights without the jargon.
Today, we're jumping into the Q3 2025 operational announcement from J&T Express. It came out on October 14th.
And this one's really important because, well, J&T only gives us the full profit and loss picture twice a year.
Exactly. So what we got was this pile of operating metrics volume, where it came from geographically, some strategic commentary.
Our job today, to figure out if this operational story, which looks pretty good on the surface, actually lines up with potential future profit growth.
Because that's the tension, isn't it? The numbers looked great operationally, but the stock actually dipped, closed down about 1.03% after the call.
Yeah, that tells you investors are really focused on something else, not just the volume.
They want to see the margin story. Does all this scale actually make money down the line? That's what we need to unpack.
Okay, let's start with the headline figures then, the raw numbers that got everyone's attention initially.
Right. So overall total parcel volume for Q3, 7,676.7 million parcels. Yeah, it's a huge number, up 23.1% compared to last year. That averages out to 83.4 million parcels every single day.
Every day. Okay. But the geographic breakdown is where it gets really interesting, right? Tells different stories.
Completely different stories. It really shows the two tracks they're on. So Southeast Asia, SEA volume just exploded. Okay. 1,996.8 million parcels.
And the growth rate there?
An incredible 78.7% year-over-year growth. Just massive.
78.7% in one region. Well, that's almost hard to believe.
It is. Now, compare that straight away to China, their biggest market by volume.
Right.
Their growth was much more, let's say, controlled, 10.4% year over year. That was 5,575.8 million parcels. Still growing, but way slower.
Okay, explosive growth in SEA, steady, slower growth in China. What about the other areas?
The new markets did well, too, up 47.9%, hitting 104.2 million parcels. That's mostly being driven by Brazil, it seems.
Got it. So massive growth in one key region, deliberate slowdown in another, solid expansion elsewhere, but no profit numbers for Q3.
Exactly. You, the listener, are kind of flying blind on Q3 profits right now. We have to remember the last numbers we saw were for the first half of 2025.
And what were those again? Just for context.
H1 revenue was about $5.5 billion, up 13% year over year. Adjusted net profit margin was, well, pretty thin, just 2.8%.
So 2.8% margin in the first half. And now this huge volume surge in Q3, especially in SEA. The market's clearly asking, okay, great volume, but at what cost?
That's precisely the question hanging over the stock. Did this growth cost them a fortune in the short term?
Let's dig into that. Start with SEA. That 78.7% growth needs explaining.
Well, management pointed to a couple of things. First, their 9-month growth was actually 63%, so this Q3 surge really accelerated things. They said it was tracking way above their own forecast.
And then drive.
Big investments from the major e-commerce platforms. Think TikTok, Temu, Shippy. They're pouring money into promotions.
Oh, the buy one, get free delivery type deal.
Exactly that. Those promotions are driving huge volumes.
Okay, but here's my worry. Relying on those platform subsidies. Isn't that a bit of a double-edged sword? What if they dial back the promotions? Does the volume just disappear?
It's a valid point, but management seems to have a strong counter-argument. Market consolidation.
Meaning?
They specifically said competitors are pulling out, literally withdrawing from express delivery in certain single countries within SEA.
Really? Just packing up and leaving?
Apparently. Which signals the market is consolidating incredibly fast. J&T isn't just growing with the market. They're actively taking share from players who can't handle the pressure.
So the intense competition, maybe fueled by those promotions, is actually forcing weaker players out, leaving more room for J&T.
And that seems to be the narrative. Their market share in SEA hit 32.8% in the first half, up over 5 percentage points from the year before. They're capturing share rapidly.
So the strategy is use scale, handle the promotional volume that competitors can't, and grab the market while it consolidates.
Pretty much. And to handle that scale, they're investing like crazy. Updating the truck fleets, upgrading facilities, and automation is key here.
How automated are they in SEA right now?
That was an interesting stat. They said only 60 of their 120 sorting centers in SEA currently have automation.
Only half.
Yeah, which means there's still a long runway for efficiency gains through more automation. That's the bull case for future margins, but it also explains the heavy spending now.
Right, spending money now to hopefully make more later once the network's built out and more efficient. Okay, so SEA is all about aggressive growth and market capture. Let's flip to China.
Yeah, China's almost the mirror image in terms of strategy right now, that 10.4% growth. It's okay, but it's a definite slowdown from earlier this year. Q1 saw over 30% growth.
What's causing the slowdown? Is it just the market, or is J&T doing this deliberately?
It's a bit of both. The overall industry in China has slowed, but J&T is also leaning into this anti-involution idea.
Anti-involution. Explain that.
It's basically the regulatory mood and maybe a business strategy shift away from just relentless, often unprofitable price wars and market share grabs. It's about focusing more on quality service and sustainable profits.
So J&T is embracing that in China. Less focus on just pure volume.
Exactly. They're actively shifting their strategy towards profitability and attracting, quote, high-quality customers. They even guided that their Q4 volume growth in China might be flat or even a bit below the industry average.
They're okay with growing slower than the market.
If it means better profits, yes. They're choosing margin over sheer volume in China now.
How does that actually work? How do they select for quality?
Well, one factor helping them is that average selling prices, ASPs, are generally rising across the industry in China.
So delivery is getting slightly more expensive.
Right. And that price increase acts like a filter. Think about the customer's perspective. If you're selling something with a very low value, a low declared order value, or DOV.
Like cheap phone cases or something.
Exactly. Those kinds of sellers have super thin margins. A small increase in shipping costs can make their business unviable. So they might drop out of the market or switch to even slower, cheaper shipping methods.
But if you're selling branded goods, higher value items,
then a small price hike on shipping is less of a concern. Those customers are less price sensitive and likely represent the high quality volume J&T wants to keep. The ASP rise naturally pushes out the low margin volume.
Interesting. So the market dynamic is actually helping their strategic shift in China.
It seems to be aligning quite well.
Yeah.
Okay, let's touch on the new markets quickly. Strong growth, 47.9%. You mentioned Brazil was key.
Yeah, management highlighted Brazil. And again, new e-commerce customers coming in, like TikTok apparently, generating hundreds of thousands of new orders. Lots of organic growth there.
But there was a challenge mentioned too, wasn't there? Mexico.
Yes, Mexico. Recent tariff increases quite significant. Up to 30% in some cases are apparently hitting cross-border parcel volumes hard, slowing that growth down.
Protectionism impacting flows.
Right. But here's the interesting twist. That pressure, those tariffs, are forcing the e-commerce platforms to rethink their reliance on cross-border shipping.
What are they doing instead?
They're accelerating investment in local supply chains, building warehouses within Mexico, for example. This is driving a really big shift towards local-to-local business. So instead of shipping something from China to a customer in Mexico,
it ships from a warehouse within Mexico to that customer. Much faster. Avoids the high cross-border tariffs.
And J&T, with its existing local networks in these countries, is perfectly positioned to capture that shift.
Exactly. So the external tariff pressure is actually accelerating a trend that plays right into J&T's strengths. It's forcing faster localization of supply chains.
Fascinating. Almost an unintended consequence helping them. What else operationally? Automation came up again, right?
Yes, big focus. They mentioned a new sorting center in Guangzhou launching in Q4, specifically to handle the peak season volumes. And they threw out a number, 397 automated sorting machines across their network. Shows the scale of investment.
And there was something about individual parcels, non-e-commerce stuff.
Yeah, a smaller point, but maybe significant. Their business simming parcels for individuals or handling returns is growing. It hit 4.6 million parcels in Q3, making up 7.7% of their total business. That's up from 6% last year.
Why does that matter?
It suggests their service quality and brand image might be improving. People are choosing them not just because they're the cheapest option tied to an e-commerce platform, but for other shipping needs too.
Okay, good point.
Yeah.
And quickly on the financials, they gave a snapshot of their balance sheet.
They did. Liquidity looks okay. About $1.77 billion in cash and equivalents against $1.71 billion in borrowings. Reasonable balanced.
And they have that share buyback program authorized.
Yes, the board approved up to $1 billion for share buybacks back in September. So they have that tool ready to use if they feel the stock price doesn't reflect the underlying value. It's a signal to shareholders.
Okay, so let's pull this all together for the investor context. We have these really strong operating numbers, especially in SEA.
But the stock reaction was muted, even negative. Management sounds bullish, particularly about CSEA's potential and the capacity they're adding.
Yet the market is stuck on this valuation gap, worrying about the cost of all this growth and when or if it translates into strong profits.
Right. So what should people be watching for? Near-term catalysts.
Definitely Q4 peak season execution. How well does that new Guangzhou hub perform under pressure? That's a big test.
Also, the pace of the share buyback. Are they actually deploying that capital? It would signal confidence.
And the absolute critical thing? Any updates or even hints about unit economics and margins when they finally report full year 2025 results? That's what everyone's waiting for.
Until then, this anxiety about profitability is likely to linger.
All right. Perfect setup for our final segment. Given this clear tension, strong operations versus margin worries, let's pitch an outrageous but plausible trade idea. And just to be crystal clear, this is purely a thought experiment based on the call data. It is absolutely not financial advice.
Okay, disclaimer acknowledged. So the market's current narrative is, cuts are high, profits are thin, show me the money.
Our counter thesis, our slightly outrageous idea, is built around a leveraged long position.
The argument being?
The argument is that the market is underestimating how quickly J&T's massive investments in automation and network optimization, particularly in SEA, are going to pay off.
So you think a profitability surge is coming, and sooner than expected?
We think the combination of two factors is being underestimated. First, the market consolidation in SEA is happening. Fast competitors are literally leaving. That reduces pricing pressure dramatically.
Okay, less competition. And the second factor?
The second factor is a rapid deployment and scaling of all that new automated capacity they're installing. Once those automated hubs are running efficiently, the operating leverage could be huge.
Meaning unit costs could drop significantly.
Exactly. We think the unit economics could improve much faster than consensus expects, maybe starting to show up strongly in the first half of 2026 results.
So the trade thesis is basically, the current margin anxiety is an overreaction. The market isn't fully pricing in the combined effect of vanishing competition and hyper-efficient new infrastructure coming online.
Precisely. The heavy spending is seen as a negative now, but it could flip to a massive positive surprisingly quickly.
It's definitely playing the contrarian view against the current market sentiment. Okay, interesting idea.
So to wrap up our deep dive today, J&T is playing two different games very effectively. In Southeast Asia, it's all about scale, capturing market share as competitors retreat.
While in China, it's a pivot towards quality, profitability, and higher value customers, even if it means slightly slower volume growth.
And the final provocative thought we want to leave you with today relates to those external pressures, like the tariffs in Mexico.
Right. Normally, you'd see tariffs as purely negative, a headwind.
But could it be that these protectionist measures, by forcing e-commerce platforms to rapidly build out local-to-local supply chains, are actually acting as an unintentional massive accelerator for J&T?
Pushing the market exactly where J&T wants it to go, but faster.
Could this ultimately allow them to dominate these regional logistics networks much more quickly and completely than they could have achieved through purely organic market evolution? That's the big long-term question to ponder.